Supply and demand is one of the most powerful concepts in smart money trading. And if you trade gold, Bitcoin, or Eurodollar, mastering it can completely change the way you read the market. These zones reveal where institutions entered, where major moves began, and where price is most likely to react again. In this episode, I'll show you what supply and demand zones really are, how they form, and how to identify the highest quality areas on the chart. Then, we'll break down the complete trading model step by step and show you how to combine higher timeframe zones with lower timeframe confirmations to find A-plus setups, especially on gold and Bitcoin. Welcome back, traders, so let's get started. Supply and demand is one of the most important concepts in smart money trading. Every trader needs to understand it because these zones are a major foundation of price action. Many of you ask, what strategy works best for gold, Eurodollar, Bitcoin, or other major markets? The answer is simple: supply and demand. Especially in volatile markets like gold and Bitcoin, price often reacts strongly around these zones. If you do not include them in your trading model, these markets can quickly expose weak entries and wipe out your capital. Let's start with the basics. In a bullish scenario, when price pauses and then breaks a major high with a strong impulsive move, it leaves behind an unmitigated demand zone at the origin of that move. Similarly, in a bearish scenario, when price pauses and then breaks a major low with strong momentum, it creates an unmitigated supply zone. So, supply and demand zones are essentially the areas from which price launches an impulsive move that causes a break of structure. However, the pause before the breakout is just as important as the breakout itself. This is the quiet phase where price consolidates within a narrow range, builds liquidity, and prepares for the next major delivery. Once enough liquidity is gathered and smart money enters the market, the real move begins. Another important tip is to pay attention to how long price remains inside the consolidation. In many cases, a well-formed pause followed by a strong breakout can create a higher quality supply or demand zone, increasing the probability that price will react when it returns to that area. To identify supply and demand zones correctly, focus on the origin of the impulsive move that caused the break of structure. This is the exact area where price aggressively moved away. In a bullish scenario, the final down close candle, or a series of consecutive down close candles, at the origin of the bullish impulse represents the demand zone. These candles usually form inside or immediately after the accumulation phase. For example, in this case, the last two consecutive down close candles formed after a temporary pause and before the expansion move. Together, they create an unmitigated demand zone. Here, we have another demand zone formed by these three consecutive down close candles. They appeared after a short accumulation phase at the origin of the impulsive move that broke the previous high. The same principle applies in a bearish scenario. The final up-close candle, or a series of consecutive up-close candles, at the origin of the bearish expansion represents the supply zone. These candles also form inside or directly after the accumulation phase. The time frame you use to identify supply and demand zones is extremely important, especially when trading volatile markets like gold, Bitcoin, and Eurodollar. If you trade every zone that forms on every time frame, you will most likely end up taking too many low-quality setups. That is why choosing the right time frame combination is crucial. Supply and demand zones on the 4-hour and 1-hour charts are generally more reliable and more likely to be respected. My preferred combination is the 4-hour chart for market analysis and identifying high-quality zones, and the 15-minute chart for confirmation and entry models. You can also use the 1-hour and 5-minute combination, but you need to be more cautious. Here is another important tip. When price first touches a supply or demand zone, do not trade every minor reaction. If most of the zone remains unmitigated, price may push deeper to fill the remaining orders before reversing. Entering too early can make you liquidity for traders positioned at better prices. So, wait for price to mitigate at least 30% of the zone before looking for lower time frame confirmation and an entry. Now, let's break down the supply and demand trading model and see exactly how to execute trades with it. But before we continue, in a bullish scenario, the first step is to confirm that buyers are in control. You can do this by identifying a clear uptrend with at least two consecutive bullish breaks of structure, or by spotting a valid change of character after a bearish trend. Once the bullish direction is confirmed, focus on the most recent break of structure and trace price back to the origin of the impulsive move that caused it. This is where the demand zone is formed. Next, highlight the most recent unmitigated demand zone on the higher time frame and wait for price to return to it. Once price enters the zone, move down to the 15-minute or 5-minute chart and look for your first confirmation of a reversal. This could be a bullish change of character or a market structure shift, showing that the temporary bearish pullback is ending and price may realign with the higher time frame trend. Once bullish structure is confirmed and we expect price to move higher, the next step is to look for a buying opportunity. At this stage, we can use three different entry models: the classic fair value gap, the mitigation block, or the breaker block. These areas often attract price during the retracement and can provide a precise entry before the bullish continuation. Now, let's briefly break down each of these entry models. Starting with the fair value gap entry model. First, price must return to a 4-hour or 1-hour demand zone. Once it reaches the zone, we move to the lower time frame and wait for a bullish market structure shift. This is our first layer of confirmation. After the structure shift, we identify a bullish fair value gap inside the impulsive leg that caused it. This imbalance often attracts price back before the bullish continuation, giving us a precise entry opportunity. We place a buy limit order at the upper boundary of the fair value gap and set the stop loss a few pips below the recent swing low. For take profit, you can target the nearest liquidity pool on the lower time frame or a higher time frame key level when expecting a larger move. The same model applies in a bearish scenario, but in the opposite direction. The second entry approach uses a mitigation block. After price taps into a higher time frame demand zone, we move to the lower time frame and look for a bullish mitigation block as a potential long entry. For this pattern to form, price must first create a swing low, followed by a swing high, and then a higher low. Afterward, we need a strong bullish displacement that closes above the previous swing high and confirms a market structure shift. The bullish mitigation block is the up-close candle, or series of consecutive up-close candles, formed between the initial swing low and swing high. To execute the trade, we can place a buy limit order at the upper boundary of the mitigation block and wait for price to retrace and activate the entry. The third entry method is the breaker block. Unlike a mitigation block, which forms with a higher low, a bullish breaker block requires price to create a lower low. Price must first form a swing low, followed by a swing high and then a lower low. After taking the previous low, price should immediately expand upward and break above the swing high, confirming a bullish market structure shift. The up-close candle, or series of up-close candles, formed between the initial swing low and swing high becomes the bullish breaker block. This is the area we can use to enter a long position when price retraces back into it. The same concepts apply to bearish entry models, but in the opposite direction. Now let's solidify everything we've covered with some real trade examples. For example, on this 4-hour euro-dollar chart, we can see two consecutive bearish breaks of structure, with the most recent bearish BOS located right here. At the origin of the bearish move that caused this break, price formed a short consolidation, leaving behind a fresh supply zone. So I'm going to highlight these two up-close candles as our 4-hour supply area. This gives us an ideal location to look for short opportunities, but only after price returns to the zone and provides confirmation on the 15-minute chart. At this point, we move down to the 15-minute time frame and monitor price action more closely. What we want to see is simple. Price should enter the 4-hour supply zone, show rejection, and then form a bearish market structure shift. As you can see, price tapped into the higher time frame supply zone, mitigated more than 30% of it, and then formed a clear bearish structure shift. This shows that bullish momentum is weakening and sellers are beginning to regain control. Our 15-minute bias now turns bearish, allowing us to start looking for a short entry. Looking closely, we also have a bearish mitigation block formed by these two down-close candles before the displacement move. Price first created a swing high, followed by a swing low and then a lower high. Afterward, a strong bearish displacement closed below the previous swing low, confirming the structure shift. We now have the 15-minute entry area we were waiting for. With these confirmations in place, we can expect price to retrace into the mitigation block before continuing lower toward the sell-side liquidity. My entry is placed at the midpoint of the mitigation block with the stop loss a few pips above the recent swing high. For take profit, I'm targeting the sell-side liquidity below this swing low, giving us approximately a 3-to-1 risk-to-reward ratio. Now, let's play the chart and see how the trade works. As you can see, the order was activated. After a brief drawdown, price rejected the mitigation block, moved lower, and eventually reached our take-profit target exactly as anticipated. Now, let's move on to the next real chart example. Here, we have the 4-hour Bitcoin chart. As you can see, the overall market structure is strongly bullish, with Bitcoin trading in the middle of a clear bull run. Price has recently formed a bullish break of structure with this strong momentum candle, breaking and closing above the previous swing high. This confirms that buyers are in control, so our focus should be on finding long opportunities. Next, we trace price back to the origin of the impulsive move that caused the break of structure. This is where our 4-hour demand zone is formed. Notice that I'm not highlighting these two down-close candles. Price has already traded below the red candle through the wicks of the following candles. Also, since I avoid using more than 3 candles to define a 4-hour supply or demand zone, I mark the area from the lowest point of the expansion move, its true origin. This gives us a fresh, unmitigated demand zone and an ideal area to look for a long setup if price pulls back into it. Now, let's play the chart forward. As you can see, price returns to the demand zone and begins to show rejection. At this point, we move down to the 15-minute chart to monitor price action more closely and look for a valid reversal confirmation. After tapping into the 4-hour demand zone, price rejects and forms a bullish market structure shift by breaking and closing above this 15-minute swing high. This shows that selling pressure is fading, buyers are stepping back in, and price may now realign with the bullish 4-hour trend. Once the structure shift is confirmed, the next step is to identify a suitable entry model, such as a fair value gap, mitigation block, or breaker block. In this case, price creates a bullish fair value gap inside the displacement leg that caused the structure shift. This imbalance may attract price back before the bullish continuation. So I place a buy limit order at the upper boundary of the fair value gap and wait for price to activate the entry. Now, let's see how the trade develops. As you can see, price retraces into our buy limit order, activates the position, and then pushes higher exactly as anticipated. This example shows how combining a higher timeframe demand zone with lower timeframe confirmation can produce a precise, high-probability entry. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.